Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and before we begin, I just do want to clarify that I was very sick last week, which is why I didn't upload a video, but I'm back this week. I'm definitely feeling better, but I still have a pretty strong cough, and of course, my nose is still stuffy, so bear with me if the energy is a little bit down this video, and if you hear me pausing in order to cough, or if you see cuts in the video, it's probably because I'm just coughing a little bit. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. Now, with that being said, I don't want to waste any more time. I've been looking forward to recording another video, and we can take a look at my portfolio dashboard first. In total, I invested $29,327. My portfolio value is sitting at $40,765, which gives me an unrealized gain of $11,438, or a total return of 39%, which is actually down just a little bit. Had I recorded last week, I think I was sitting at about a 43% total return, but since then it's gone back down to 39%, which is still solid. All in all, I have earned $1,137 worth of dividend income, and my yearly projected income going forward is $720, which gives me a portfolio yield of 1.77%, or a yield on cost of 2.46%. Now, real quick, on the most recent trading day, my portfolio was down almost 1.5%, and that equated to a $614 drop, which is getting pretty substantial. If prices continue dropping, I can definitely see myself making some purchases in the market, and I've been eyeing Google pretty closely at these price levels. Now, that's enough yapping about my portfolio. This video is a review my pie video, which is a continuation of a series I started a couple months ago. I had one episode out, which I'll pin right here if you guys want to check it out. But basically, I had a subscriber send over their portfolio to my email box, and they sent me a bunch of information about themselves and their holdings, and we're going to be reviewing their portfolio today and giving it a score between 1 and 10. Now, keep in mind the score is just for fun, so don't be taking it too personally. It's just a way for me to say if I like the portfolio or not, and of course, it's just my opinion, so it doesn't matter at all. Now, let's start by taking a quick look at his About Me section, and I'm not going to be dropping his name in the video. If you are watching this video and you want me to mention your name or you want to be pinned, just leave a comment down below. I'd appreciate that, and I can definitely pin it if I see it. So in terms of the About Me section, he says he's got a 25-year time horizon, which is a decent amount of time to be investing, and is currently married, so congratulations. He's only been investing since March 2023, so I'm guessing his returns are going to be a little bit on the smaller side, but I don't believe he gave us his returns anyways. So if you are watching this video and you want to leave some of your returns on some of your companies, definitely leave them down below. He has both an accounting and IT background, which is very strong, and those are pretty good careers to be going down, especially accounting. It's very solid and it pays pretty well. And he has goals to sell his stocks and purchase dividend ETFs down the line. What I'm assuming by this is he's trying to get most of the price appreciation for his stocks right now with individual holdings. And then once he's ready to retire, he's probably going to be moving all those individual holdings into ETFs in order to kind of take the thinking out of it and just make it much more consistent in terms of return and wealth management. For his methodology, this is where it gets interesting. He likes to do contrarian investing, so I'm guessing he wants to do what kind of the opposite of what a lot of other people do. He's not trying to look for those big hype stocks like Apple, and we can see right here I focus primarily on boring, uncovered, or unloved small and mid-cap companies that reliably grow free cash flow per share or their book value per share for their financial companies. Now, this is a pretty solid approach. I personally do not do contrarian investing. I tend to buy very well-known blue chip companies. That's just my preference, but this of course is not a big deal that he doesn't choose to do so. The main thing that's important here is he's looking for growth in the free cash flow per share of the company, and that's a very good metric to be looking at. A lot of times when I do my stock analysis videos, you'll see that I take a look at the free cash flow per share metric because it's very indicative of how the company is performing, and it helps show whether or not they're going to be able to continue growing their dividend and if they have the ability to cover that dividend going forward. Now, some of the stuff he likes and dislikes, he likes companies that have founder-led or insider ownership. I think this is very important. This would be a company like Meta, for example, where Mark Zuckerberg is still heading the company as CEO. And I think that's something that he'd be looking for, but of course, maybe a lesser known company, not a company like Meta, it's too well known. And then a free cash flow payout below 40%. That definitely helps guarantee that the dividend is going to be safe going forward. Now, the last bullet point here, which we can see that mentions something that he likes, is the annual dividend growth of at least 8%. That would be very strong dividend growth, and companies that are able to consistently grow this way, like companies like Visa and MasterCard, tend to have a pretty good dividend growth history, and they tend to grow pretty quickly. Now, in terms of stuff he hates, which is a very strong word, is intense coverage of stocks. So that kind of goes back into the contrarian investing. He likes more boring, uncovered, or unloved small and mid-cap companies. And he doesn't like hype or hot stocks, so a company like Nvidia would be a no-go for him, I'm sure. So let's just move right into the Excel sheet that he sent me over, and this is very helpful. He sent me over a spreadsheet with all his allocations, some information about the companies, and all his different holdings, including his cash allocation. Now, if you guys do want to be featured in a future Rate My Portfolio video, definitely send me your portfolio holdings and as much information as you can include. Now, I'll leave a comment down below kind of explaining what I'm looking for, but basically the more information you can give me, the better, because that gives me a better idea of your portfolio and what your goals are. So if you give me your time horizon, your goals, your allocation, your dividend yield, what you're looking for within each company, your cash position, that helps me out a ton. I can definitely do a video on that in the future. Now, the best way to send that over to me would be via email, and I can show you guys how to find my email, basically being the About Me section of my YouTube channel, and I'll put up a screenshot right here kind of showing that. But if you guys prefer, you can also leave that in the comments of this YouTube video just in case. That helps me out a ton. So taking a look at his holdings, something he sent me in the Microsoft Word document, which I just copied over here, is this nice little visual of his different holdings, which is much appreciated. I'm going to be using that right now. Now, the first thing just looking at this is that there's a lot of holdings here, a lot of different separate holdings that this person has. And so I'll be covering some of the interesting ones that I found, but a lot of these companies are actually new to me, so I had to do some research on them before making this video. It seems that overall these companies have lower dividend yields with some inconsistent growth. So not all of them have like 10 years of consistent growth history. Rather, they have like maybe 1 or 2 years, but they still have a good 5-year growth of their dividend. Now, another thing that I did notice with a lot of these holdings, which kind of goes hand in hand with him saying that he buys lesser known holdings, is that the PE ratio of a lot of these stocks is actually on the lower end. Now, that could mean there's some hidden value there, or of course the market just hasn't priced them in as rich as they have some other blue chip companies like Apple, Microsoft, Nvidia, etc. So the first one that really sticks out to me is Primerica, and that's because from what I've heard about it before, it is definitely known as a bit of a pyramid scheme, or if we want to be polite, we can say multi-level marketing scheme, and really what they sell is insurance. So if we go on Google real quick, the first thing we can see here is that it is a multi-level marketing company, which is a polite way of saying pyramid scheme. That's how they define themselves, of course. And if you scroll down a little bit further, you can actually see, work for a company called Primerica. Yes, it's a pyramid scheme. They will try to get you to sell life insurance to your family and friends. You won't really make any money. So personally, I'm not a big fan of this company for that reason. Now, I don't know a lot about their business model, and this is just my personal opinion. So it doesn't mean that the portfolio has chosen a bad holding, but in terms of what the company does, it's just not my favorite. Now, one thing we should consider though is that the performance is what really matters here for an investment. If he doesn't care about what the company does, then it's totally fine. And we can see here that the 1-year performance is solid at 27.74%. The 5-year performance is amazing at 115%, and the 10-year performance is just crazy at 426%. So it definitely outperforms the S&P 500 in the long run, and that could be a big reason why he's purchased this company. Their valuation is a little bit on the lower end, like I said, maybe not for their industry, but definitely compared to tech companies. And in terms of growth, they still have some solid growth ahead of them at 8.67% year-over-year revenue growth, and a forward-looking growth expected at 4.5%. So this performance might continue pretty strong going into the future. Now back to this list over here, we also have Kinsale Capital Group. So I didn't know much about this company, and I still don't know too much about the company. It basically sells specialty insurance from what I figured out, but the revenue growth on the stock has been crazy, and we'll take a look at that in a second. I'll kind of group this all together with a couple other companies so we don't have to go back and forth between here and Seeking Alpha. Now finishing up the financial section, we also have ARC or Arch. They're also an insurance company, and then we have International General Insurance Holdings. So this person really likes insurance companies for their financials. Something that maybe recommend would be to diversify a little bit outside of insurance. Insurance is a pretty strong business, and I do own United Health myself, but maybe some more financial companies, something like a bank like JP Morgan Chase could be a good addition to this sector right here. Now in the information technology sector, we have Fortinet, which deals with cybersecurity and has some pretty solid growth. We do have Topicus, which I'm not as familiar with, but they are a software solutions company. And then we have 2 semiconductor related stocks. We have Photronics, which is semiconductor related, and we have Skywater. Like I did mention, I'm not too familiar in this business. I do like Fortinet a lot. Photronics seem to have some solid performance, but Skywater has definitely been having a pretty hard time, at least in terms of stock price appreciation. Now, the consumer staple category, I actually like all the holdings in here. Altria Group is a very high yielding dividend stock. Now, of course, its upside potential in terms of stock price appreciation are a little bit limited, though I do think it has been undervalued for a while. And now we've seen a pretty crazy run up this year, which I'll put a picture up real quick. But then we also have Casey's, which is basically a convenience store brand, and we have Couche-Tard, which kind of deals with the same thing. And sorry for my butchering of the name, but Couche-Tard owns Circle K, and their stock price appreciation and performance has been great. Now, recently, this company also did put a bid in on 7-Eleven. I think it was like a $39 billion bid, but it fell through. 7-Eleven declined the opportunity to be bought out by Couche-Tard. So for now, they're going to continue being held by their own holding company. Now in industrials, we have Copart and Mueller. Not too familiar with Mueller Industrial. I think they sell like copper alloys and stuff like that. But Copart, I have actually been tracking for quite a while. I've been waiting for a substantial dip in stock price to potentially start a position of my own, but I haven't seen any opportunities just yet. But Copart is basically a very solid online car auctioneer, so they make a ton of money doing that. Their stock price performance has been crazy, and if there's any good opportunities, I might jump into it myself. Now in terms of consumer discretionary, there's Dreamfinders Homes and there's Academy Sports and Outdoors. Not familiar with Dreamfinders Homes, but Academy Sports and Outdoors is kind of a sporting goods company similar to Dick's Sporting Goods, or maybe you could say it's a smaller scale kind of Bass Pro Shop. But the company has been doing fine for itself. It IPO'd pretty recently and so far has been having some pretty solid stock price performance. Now last, we have the ETFs here. We have SCHD, SCHD, and DSTL, and we'll go over those separately real quick after I finish looking at these individual companies. But these are all pretty solid holdings. DSTL we'll talk about in a little bit more detail, but SCHD and SCHD are fantastic ETFs to be holding, and they make a majority of his portfolio at 34, maybe not a majority, but the largest position up in his portfolio at 34.4% of the portfolio, which will give him a lot of stability, which is something that I like to do. I personally hold 50% of my portfolio in ETFs, and then the rest is divided up into individual stocks. And then last but not least, we have the cash position at 4.1%. Now this portfolio was sent to me quite some time ago and I just hadn't gotten around to making a video on it. So of course the cash position might be higher or lower at this point, but this is pretty strong, gives him an opportunity to buy into any new positions that he'd want and at least make a 2% position in his portfolio in them. But I wouldn't be surprised if he's been growing this cash position in the meantime. So going back into Seeking Alpha, I just wanted to show you some of the ones that I found pretty notable. We have Kinsale Capital Group here, and if you look at their 5-year returns, it's insane, 350.77%, some of the highest 5-year return that I've seen. And then in terms of 10-year return, it actually doesn't mention it here, but I believe it was closer to 2,000%. So that's pretty strong. Now in terms of valuation, it's trading at a pretty rich valuation, close to a 32 price to earnings ratio, but the growth has been absurd. Their year over year revenue growth has been 38.25%, and the forward looking growth is still expected to be 32%, which kind of, in my opinion, warrants this valuation if they're able to hit that growth metric. Now you can see right here how steep the revenue growth has been, and that's the main driver for growth for this company. Not only that, but the free cash flow per share has been growing basically just as quickly, which means that they have a very strong ability to both grow their dividends and then pay off any debt that they might have. Now in their information technology holdings, my favorite of theirs was Fortinet. It is a cybersecurity company, which I think is something very important going forward. And then also you can see that their growth has been fantastic. Their 10-year growth at 13-20%, which is amazing. Now the only thing that might be of concern is that there's a pretty high price to earnings ratio that they're trading at, and a lot of that is due to their growth being at 11% and 14% respectively going forward. That's pretty strong, but if the growth does kind of falter a little bit, it might very much affect their valuation. And we can see the valuation contract back down to lower levels, maybe like a 30 price to earnings ratio, which could of course drag the stock price down with it. Now, Altria Group is one that's usually not that exciting, but in the past 1 year, the company has been up a lot. And if you look year to date, they're actually up 33%, which is insane. It's a pretty decently sized holding of mine, making up over 2% of my portfolio. And I'm very happy that I bought a position into it at the moment. Now, of course, tobacco sales overall, especially in the cigarette market, are going down over time. So this could actually just be a temporary growth spurt that we do see here. But if it does hold up and does continue, that'll be pretty solid for the company, especially since it pays a 7.6% dividend yield going forward. So even if you're not getting any more price appreciation in terms of growth, you're still getting, that dividend yield reinvested back into the company if you choose to. Now, the company is a dividend king with a 54-year dividend growth history track record, and their 5-year growth rate is sitting over 4% at 4.14%. They recently announced another dividend bump, which was another 4% dividend bump basically, which is very good for such an established company. In terms of valuation, they trade on the lower end, but of course there's a lot of reasons for this. They were trading even cheaper just a couple months ago, and the main reason is because the uncertainty in the tobacco industry and their inability to grow their revenue at a fast pace. The main way in which they have been growing their revenue for the past couple of years has just been increasing the prices on their tobacco products, but of course that might not be sustainable going into the future, especially as they continue to lose customers. You can see right here what I mean. The revenue growth year over year has actually been going down most recently, and the revenue growth looking forward is actually expected to be pretty flat. So it's not great to see, and it's definitely not a growth type of investment if that's what you're looking for. Now, the last company I want to take a look at on Seeking Alpha is Copart, and like I said, they do auction off cars online. I believe it's fully online auction, so it's probably a pretty profitable business. But as you can see right here, their 5-year growth rate is at 143.11%, which is strong, and their 10-year growth rate is at 1,078%, which is amazing, and the company does not seem to be slowing down just yet. In terms of revenue, the company has been growing pretty quickly, and I'm sure they've been rewarded by the kind of increase in prices in the used car market and the increase in demand with a lower supply still available. They do trade at a pretty rich valuation, which does make sense with the kind of growth we've seen over the past couple years, but I'd be looking for a much lower valuation than this in order to buy into the company anytime soon. In terms of growth, it is solid, but it's just under double digits, 9.5% year-over-year growth for revenue, and the forward-looking growth is at 9.12%. Now, the company does not yet pay a dividend, so of course they could start that up at some point if they decide to, which would be nice for dividend investors. So let's just start with schd. It is the first one on the list and it is my favorite of the bunch. And if you guys want to see a more detailed video about schd, going over my holding in it as well for the past couple years, check this video out right here. I'll pin it up top. Now, in terms of expense ratio, it's at 0.06, which is very low. It's on the lower end of ETFs. 0.03 would be even nicer, but of course, this is a little bit more of a premium ETF because it does take a little bit more management into account. Now, the only thing I want to take a look at real quick is their holdings. We can see that Lockheed Martin makes up 4.6% of the portfolio's holdings. Then you have AbbVie at 4.38% and Coca-Cola at 4.19%. Now, most of these holdings are equally weighted on a quarterly basis, but of course, during the quarter or during the year, some of them are going to become overweighted just because of price appreciation. We can see that overall, there are some solid companies here, but we do have some slower growers like Coca-Cola mixed into here. We also have some companies that have had some struggles growing over the past couple of years, like Cisco has not been so consistent. We also have Bristol Myers Squibb, which has been pretty rough. If you guys do want to take a look at schd yourself and view all the holdings, you can press the view all holdings button or export all holdings button if you choose to do so. Next, we have schd, which is another ETF sold and managed by Charles Schwab. And we can see here the expense ratio is actually on the lower end at 0.04%. And the main focus of this ETF is actually to focus on high growth, large cap companies. Now, if you guys ever want to look into its methodology, you can just look up the Dow Jones US Large Cap Growth Total Stock Market Index, and that's what they base it off of. Now, in terms of holdings, you can see some familiar names to the S&P 500, the VOO ETF, but the allocation is completely different. So we have Apple at number 1, but it's at 12.16% of the portfolio, and then Microsoft at 11.5%, followed by Nvidia at 10%. So you can see this is much more aggressively overweighted into tech companies. Now, depending on your time horizon and risk tolerance, this could be a very good choice for a lot of investors, because if you're willing to wait out the swings down and ride the swings up while it happens, then this could be a very good total return compared to even an ETF like the S&P 500. Now, for the time being, SCHG is a little bit outside of my risk tolerance. I think it's a little bit too overweighted into all these tech companies, so I prefer to hold my ETFs in VOO and SCHD. But in the future, I could definitely see myself considering changing this into a more SCHG heavy portfolio, but maybe not just yet. And the last ETF that he does own is DSTL, and it's my first time hearing about it, and it's definitely the most unique out of all the ETFs. It's the US Fundamental Stability and Value ETF, and it's sold and managed by Distillate Capital. Now, the main thing here is they're looking for quality companies that have stable cash flow and low leverage, and they're looking for value companies that have high normalized cash yields. Now, like most ETFs, they have a systematic process in order to choose their ETF, so it's not based on feelings usually, it's based on calculations, and if you want to learn more about that, you can definitely take a look at their webpage. Now, the main thing I want to point out here right away is this. The expense ratio is at 0.39%, which is a little bit on the higher end than what I would like to see. As a reminder, SCHG is at 0.04%, which is basically a tenth of this expense ratio, and these definitely do add up over time, especially if you're not outperforming the S&P 500. Now, it has had solid performance overall, but if we look at the year-to-date, 1-year, 3-year returns, and even the 5-year returns, it's trailing the S&P 500, though just by a little bit in the 5-year time frame. Now, if we do look since inception, it does outperform by a little bit at 14.89% per year compared to 14.83% per year for the S&P 500. But if you include after that the expense ratio of 0.39%, this would definitely take away from this performance. Now, me personally, I would move my money out of DSTL and into a different ETF, such as SCHD if you're looking for more dividends, SCHG if you want more growth, or if you want something right in between, I would move it into an S&P 500 ETF like VOO. Now, the fund does currently hold some pretty solid holdings, including United Health Group, T-Mobile, Home Depot, and Cigna Group, but of course over time this can be rebalanced and we don't know exactly what holdings they're going to have in the future. Also, this does seem pretty heavy into healthcare and insurance once again, and so I think there's a bit of overlap between your individual stock holdings. So moving back into here, we can see all the holdings once again with the different allocations, and overall they're pretty well balanced. I think going over 5% is a little bit risky on some of these companies. I know they've been performing well, and this could be because of price appreciation, but having 7% into one holding is a little bit more on the more aggressive side for sure. If you wanted to stick it safe, you could definitely keep all these holdings under 5%, just rebalance the portfolio every once in a while by either purchasing more, or if you prefer to sell, you could sell holdings in order to repurchase more, but I'd prefer to just purchase more shares of another company. Now for the ETFs, there's no problem having them over 5%. I think this is solid right here as it is. And if we look at it, 11.8% for DSTL is a little bit on the high side, so maybe consider moving that into SCHG and SCHD as well. Now in terms of dividend yield, his dividend yield is sitting at 1.24%, which is certainly on the lower end, but I think it's totally fine. Not everybody has to invest into high dividend yielding stocks, and if his main goal is total return and then to transfer his holdings into ETFs later on in life, then it doesn't really matter what his dividend yield is currently sitting on as long as he's maximizing his total return. If in the future he wants to live off of dividend income, he can always move his holdings into higher dividend paying positions. Overall, this is a pretty solid portfolio, and I'm going to rank it a 7.4 out of 10, but that could just be me because a lot of these are companies that are outside of my circle of competence, so I don't know quite as much about them as I would like, but it's still a very solid portfolio. As always, that does bring us to the end of today's video. I know this was a slightly longer one, or at least I'm guessing it was longer because I feel like I've been here forever recording the video, but I really do hope you guys enjoyed it anyways. It was fun taking a deep dive and looking into this guy's portfolio that he sent me over, and I really appreciate you for sending over this portfolio and all this information along with it. Now, I am sorry I didn't get to it sooner, but I hope you have a chance to check out the video once it's uploaded finally. Now, if any of you guys watching the video are interested in sending me your own portfolio, just make sure that it's US-based companies for the most part. Otherwise, I'll have a hard time knowing what they deal with if you can. And just leave it down below in the comments or send it over to my email or do a combination of both. That way, I definitely see your portfolios. If you guys do like this series, let me know down below. I can start doing them more frequently as long as there's interest. And if you have any recommendations for next time, let me know as well. Thank you guys for bearing with me while I'm recovering from being sick. I really do appreciate it. And if you guys want to check out my latest video where I talk about how much dividend income I received in the month of August, check out this video right here. And if you want to see my most recent sell my portfolio, check out this video right here. Don't forget, the best time to invest was 10 years ago. The second best time is today. I want to thank you guys for watching, and I will see you in the next one.